Hello, everyone. This is Matthew Fraley with BreakpointTrades.com. First off, I hope everyone has had a wonderful weekend. It is Sunday afternoon, and this is my extensive technical analysis review of the markets weekend edition. It is currently Sunday, February 23rd. It's about 3 p.m. Eastern. As you know, we had quite a bit of rug pull last week on Friday, so we got a lot to discuss. And besides the market sell-off on Friday, here's the NASDAQ. You can draw a potential wedge-like pattern. You have an uptrend line here just below. Here's the S&P 500. Walmart got smashed last week on earnings. We have NVDA earnings this Wednesday, February 26th. After the market, you can see how it rallied up to a downtrend line. So that and PCE is going to be important. Obviously, as far as economic news, anything out of the Trump, Elon, DOGE team, any crazy tweets, trade war stuff, that could all move the market. So volatility is back, baby, and, be on your toes. But we'll see what happens earlier this week with this quite oversold market at the moment. Again, my name is Matthew Fraley. I founded Breakpoint Trades way back in 2003, 22 years ago now, to provide the best technical analysis on the internet, amazing market newsletters, trade ideas, my personal passion, mechanical trading systems, helping our subscribers. We have folks from all walks of life. We have young folks, we have day traders, swing traders, we have folks managing 401ks, crypto traders, precious metal, commodity, gold bugs, you name it. Lot here. You should at least consider subscribing to our free newsletter so you can get some updates. And honestly, over time, you should sign up. Our memberships are very reasonable, and I think you'll be impressed. Anyway, let's get back to things at hand. So, guys, as you can see here, this newsletter is divided into 9 major sections. Didn't really add any new trade ideas. We got enough charts to discuss. Sometimes it's information paralysis, less is more. But again, on the weekend, we like to cover a lot of things to show you a broad overview. Because again, our subscribers here, we have all sorts of subscribers who look at all sorts of things. But anyway, a lot to discuss here. I am going to try this evening to do a video on our systems, our KISS systems, and our mean reversion systems. I have a major update, major improvements that I've added to the KISS high performance systems. I'm in the process of retooling those. I'm seeing anywhere from 20% to as much as 80% improvements. So I'm very excited there. It's going to take some time to get all that done. And I think the market's going to have a lot more volatile year this year. I'm surprised none of the mean reversion systems triggered on Friday, but I wouldn't be surprised if we start seeing some of those trigger this week if we get a little further through sell-off. Again, this week, like I said, the big items, NVIDIA earnings on Wednesday, PCE, PMI on Friday, inflation data, and of course anything out of DOGE and Elon and Trump, etc. Again, big rug pull on Friday, as you know. Not surprised the market has held up this long, just given the uncertainty. So we finally saw a release on Friday. The Bollinger Bands, I've been warning about how they've been very compressed on the daily chart. I mentioned a couple weeks ago. You can see here on the Bollinger Band chart how compressed those Bollinger Bands were. You can see my comments from February 12th on this image. Again, you need to be on YouTube to see this. So this was kind of a warning a couple weeks ago, and there was an uncorrelation last Thursday, which ended up playing out. But, we have a pinched Bollinger Bands, which could result in the VIX moving up if it wants to for a bigger correction here. The market eventually is due for a choppy year. We've had back-to-back well over 20% year gains on the S&P. So could be a year that, is a much more choppy year. And I think, mean reversion systems could start coming to life, and some of the KISS systems, if you're just following the market indexes, could be more choppy. So my suggestion would be to look at some other KISS systems that are non-market correlated, such as some of the commodities and precious metals, stuff like that. Anyway, let's get started here. Again, a lot to discuss. So Item number 2, this shows you the index sector table, what transpired on Friday, and of course for the week. Again, Friday was a big sell-off. The major index is selling out from 1.7 to 2.9%, with the Russell leading down. So big losses for the week, as you can see. And as far as the 21 market sectors, broad-based sell-off on Friday. Only 3 sectors slightly up here. Consumer staples, which is defensive anyway. Drugs and utilities, all defensive sectors. But everything else was smashed down for the week. Most things are smashed down as well. Currencies, US dollar, up on Friday, but down slightly for the week. Cryptocurrencies, Bitcoin's been very choppy the last, say, few months. And so didn't do too much. Didn't really sell off hard last week, but it didn't rally with the market recently either. And as far as commodities, big sell-off on Friday for most of the commodities, including the precious metals, but a lot of them are still up for the week. Well, the index is up still 1%. Crude oil down 0.6%. Natural gas up 12.5%, so maybe that's skewing things a bit. Natural gas moves a lot with the weather. Plus, it was at a big long-term support a couple months ago, so it's coming off that. But otherwise, pretty good losses on, I'd say, most of the individual commodities, such as copper, uranium, agriculture, coffee, you name it. Gold and silver still managed to close up for the week. Gold still has not tagged that 3,000 round number, which to me is at least a target, but it hasn't tagged it yet. Silver was up. But the miners are out underperforming here, GDX, so be aware of that. And as far as the bond market, it didn't, even though the 10-year, 30-year Treasury yields fell for the week, didn't help the market. Okay, and that yield curve, remember, it's no longer inverted. CNBC keeps talking about a soft landing, guys. I still stand by my point. We are going to eventually have a recession. Maybe some of this DOGE stuff, how the speed of cuts there, maybe that'll cause some future recession. Because let's face it, the government is such a huge part of the economy. And finally, item number 3 shows the economic news calendar. Again, a lot of different news items here. The big one, of course, is Wednesday, NVIDIA earnings. Friday, you have a bunch of inflation data, the PCE, Chicago PMI. Again, there's plenty of other things that could come from Trump or Elon or whatever. So anyway, let's jump to the charts. So first chart below, item number 4 is NVIDIA. So NVIDIA, as you know, bounced off this demand zone in late January that we had identified, rallied up, stalled at the downtrend line, pulled back on Friday, obviously. Earnings is on Wednesday, so let's see how it reacts to that. Again, logical pullback from the downtrend line here. It's got a bunch of major moving average support here, but we'll see how it reacts. Some other earnings. Meta had earnings in late January, and as you know, it had a heck of a rally out of that coil pattern that we showed, but it got quite overbought, and it's finally correcting. It is into a little demand zone here now, but if it doesn't hold that, you have the 50-day moving average below. And last week, what really set the market selling off was Walmart. So Walmart had earnings. Again, as I commented last Wednesday, Walmart had already had a big rally out of this tight coil. It had a heck of a move off that December 2023 low. You could see, going from $50 all the way to over $100. That's a big move for Walmart. It's not a high beta tech stock. So I said the risk of holding Walmart into earnings was quite high because it was already extended. You could see the RSI divergence. So it got smashed on earnings, warnings about the economy, and it's been selling off. You can see it actually closed below its 50-day moving average. So that's a concern. Here I added some fibs that could be targets over time. So be aware of that. And chart number 7, here's Walmart from the KISS systems. Remember, we have all these 750 stocks in the KISS system tables. This is not a high performer, it's just the standard system. You can see caught a nice trade last year from July till December, it looks like, and then it went back long in January, and it got out on Thursday before Friday's sell-off, but it made money on both of those trades. Next, some other things I saw on the weekend. This was sent to me from a subscriber, from Sentiment Trader. I don't subscribe to Sentiment Trader, but if any of you Sentiment Traders or happen to listen to this, again, this is free advertising for you. If you want Sentiment Trader, you could subscribe to them, whatever. But again, they're shown here, their Sharpe ratio that is when it gets up into this range, has been near peaks in the market. Again, I can't directly reproduce this chart, so I don't have a lot of comments on it, but just showing this for informational purposes. Besides that, we also know how Warren Buffett is so in cash, over like 320 billion in cash. So he is definitely also concerned about things longer term, especially valuations. But let's move to the indexes. So chart number 9, here's our famous BPT 401k paint dry system. It's funny, it's based on a monthly chart. A lot of folks really like this system. I think it is pretty a neat name, paint dry system. It's like watching paint dry because signals can, I think the average signal is like 3 or 4 years. So, it's good for those who, are not traders. They have a 401k. They don't want to trade it, but they want to be protected from bear markets. And that's what it does an outstanding job at doing. You can see here, it avoided the 2008 crash. It avoided the tech bubble. And, it got out in 2022, went back long in late 2022, so it's still been long. It's not saying anything new here, guys. So longer term, again, I don't think the bull market is done yet, but we could perhaps be in for a deep fourth wave correction of some sort. But longer term, this is system still intact. Reason I'm saying I don't think we have an end of the bull market yet. We are quite a bit extended here. A lot of these bull markets on monthly charts tend to have some RSI divergence or MACDs flattened out. We don't have that yet, but we are quite extended. This squeeze indicator is a pretty cool indicator. It's a famous indicator. There's a bunch of them out there for free. You don't need to go out and pay for something like that. Go to TradingView. There's a ton of them. But it's basically when the Bollinger Bands fall inside the Keltner Bands, which is rare. And so energy's built up. And you can see every time you get this squeeze dot has always occurred near big moves in the market, either up or down. Last time we got one was in mid-2023, and then the market had a big rally. Right now, it's not telling you anything. And just in case, if you're wondering, how did the BPT Deluxe paint dry system work in, the 1920s during that Great Depression, 1929 crash? Well, here's how it did. It went long in 2023 or 1923, 102 years ago. It got out here near the highs. It then bought that first pullback, sold it, and avoided that whole crash. And you can see that it caught a 2-year long, got out, caught another long, got out. So again, it's a cool system, works going back well over 100 years. But it's a monthly system. It's nothing that interests me and probably most of you. It's good though for maybe friends and family who don't trade the markets, but they still want some protection. Next, chart 11, here's the weekly KISS systems. Now, to me, these would be more my style on a paint dry. The signals aren't as long as the 401k paint dry monthly. These are based on weekly. No changes here either. These KISS systems have been long for the last couple of years. Stops are still pretty wide on them. You can see here in the NASDAQ 478.60, S&P 56.34. So still pretty wide again, which makes sense. They're weekly. They're going to give more room. And chart number 12, here's a standard monthly chart, kind of like a paint dry system. And, this shows you the bigger pictures, right? We've been in a secular bull market since the 2009 bottom. You can draw a parallel uptrend channel. Nothing's changed here. But the reason why I say I don't think this bull market is ending yet, though we could have a decent correction, you can see the MACD, that's usually you get your bear markets when the MACD is kind of flattened out or MACD is crossed or there's some divergence on the RSI, and you don't have that yet. All right. So also the 14 stochastic is when it falls below 50% is a great guide at indicating a bear market. And you can see it's way, way, way far from anything like that. But again, doesn't mean we can't have a 500 point pullback in the S&P, right? Next, moving on to the individual indexes. Here's the Dow. So the Dow, as stalled in this supply zone that we had commented, which was the previous highs. And then it formed a coil. Well, I was wondering at the time, I was favoring an upside break of the coil, but instead it broke down. It actually broke down on Thursday. And of course, huge follow through on Friday, smashing below that 50-day moving average. Here I added fibs. 61.8 fib is 43 thousand essentially. Now below that, you don't have too much support until there's an open gap down here, etc. But we'll see. A positive here still is the moving average ribbon still bullishly stacked. It's starting to pinch here, so we'll see. And chart number 14, here's the 2-hour review of the Dow, UDOW that I was showing last week. That's the leveraged. I had this at first labeled as a bullish labeling, but this is actually the way it ended up playing out. This is your bearish labeling, A, B, C, D, E. Remember, true coil patterns are 5 waves. So anyway, smash down on Friday or Thursday, and then of course big follow through on Friday. Filling one gap there. There's another open gap down here below. You can see the 61 fib. We are quite oversold in the short term here, guys. What I think on the market is, I think we're either going to get a follow-through sell-off on Monday morning and then perhaps a reversal, or we could reverse right away. It would honestly be better for the market if we get a follow-through, a red to green move, where you're weak in the morning and then reverse up. Next, moving on to the S&P 500 charts. Chart number 15, here's the weekly view of the S&P, just showing this uptrend channel here we're in. The dotted lines are your parallel channel. You can also draw an uptrend line from the August 2024 low, which connects the January low. You know, it's like it's still a little tighter, but still plenty of room there. Next, chart number 16. Here's the weekly view of the S&P with these wave counts that we've shown. And Steve and I don't like to show these too much because, again, these are for mapping purposes. You don't get your triggers from this. People get confused. There's always, different counts and alternatives and stuff like that. So we don't like to confuse you guys, but eventually we are going to get this deeper wave 4. And are we starting it? We'll see. But, wave 4, like I said, could be 500 to 900 points if that's what it is. And that would still be well within the bull market. Okay. The RSI indicators are still coiled up here. So we'll see, guys. Nothing's set yet. And chart number 17, here's the S&P equal weighted. Showed this a while back. You can see so far that rally about a month ago stalled at the 61.8 fib, lower high. So far that's been resistance. Next, chart number 18, here's the S&P high performance daily KISS system. No changes here. Sorry about that. I had to refresh this. It was old data. So, here's the S&P KISS S&P daily system. Still long. Price is nearing the ATR. By the way, remember the KISS systems, I said I have a substantial upgrade coming. I have a new version of this that I'm replacing soon. Quite a bit better stats, but otherwise it's still long, nearing that ATR. Next, number 19, here's the 4 time frames I like to look at. First off, the daily chart up here had resistance cycle. Those actually, they came in last week on Tuesday, ended up playing out just perfectly. Still above the ATR. The half day, notice the cycles, you had a resistance cycle and the ATR all kind of lined up there. So logical dump from that area. Next, move on to the S&P standard daily chart. So here's the daily S&P. So you can see the smash down. We closed right at the 50-day moving average. So again, guys, we could either get further follow through in the morning. Okay, wouldn't shock me. It would actually be better if we got a red to green move where we get weakness in the morning and then a reversal up. Okay, or we can reverse right back up. Either way, this area marks roughly 50% of this down candle. You can see you have the moving averages all lined up there. So it's possible we could get a bounce up into that area, pretty substantial bounce, but then fail there. Otherwise, a further continued decline here. Notice you have an uptrend line from the August lows. There's also an unfilled gap down here, which was never filled. There's another demand zone down here. So a lot of stuff that could be targets should this lead to a deeper pullback. Next, chart number 21. Here's another daily chart. A bunch of lines here. You can see smashing through one line Friday, closing at the 50-day moving average. These lines up here could be resistance areas on a immediate bounce back. So these, I would imagine, if we've got rallied right back immediately, it could stall right in these areas. Next, chart number 22. Here's half-day chart. Again, it's possible. Remember, we've been viewing this move up as a wave. That last low is a wave 4 in January. This move up is a wave 5. It is possible we completed it. We did make a minor new high here. But we'll see. Again, nothing's set yet. Here, we closed around I added some fibs. from the recent highs to the January lows. So we closed right around that 38% fib. So here's some other fibs to monitor. 50% fib, 61.8% could all be potential targets, and this could still form a higher low and go back up. Next, Feb 23, here's a 2-hour view, just also with the fibs on it, and shows you that gap. You can see again right around the 38% fib. And chart 24, here's a 60-minute chart. So again, we had a fifth wave high back in January, and then a perfect ABC, and then we've been moving up. All right, now below this line here negates a very bullish count, because for this to be a 1-2-1-2, which I'm not going to get into. Again, this could still ultimately be a more complex correction, but this is an important support area here. Here we lost a demand zone, so we had a break in structure. And you can see right now we have 3 waves down from the highs. That could be A, B, C. This could be a bearish 1, 2, 3. Or this could be 1, 2, 3 of A. So, and chart 25, 30-minute view shows you that wedge pattern Steve discussed on Thursday. We had a bearish break in structure here, and well, that followed through on Friday. So that was a warning on Friday, and a good reason, again, to be a bit cautious, guys. Steve talked about that on Thursday. And if you're just looking at this on YouTube, that's another reason to be a subscriber, because you wouldn't have seen this. My last video was on Monday of last week, or Wednesday. So just think about that, guys. Anyway, you can see we closed around the 61.8 fib here, so that's always an area where you at least get a reaction. No divergences, though, so I do think any bounce is temporary at this point. And finally, chart 26, here's a 15-minute view. You can see, again, A or 1, B or 2, C or 3. Again, this doesn't look bottoming. There's no MACD divergence, RSI divergence on the 15-minute time frame. So to me, any bounce we get, let's say we were to bounce up into this range, I think it's a sell. Okay. Then if you come down again, then that might be a better bottom. You can see the obvious bear flag. We pointed that out on Friday morning. And also look how useful the moving average ribbon is. Went bearishly stacked, and that first pinch squeeze, that's always a good short. But moving average ribbon is pretty wide here, so wouldn't be surprised if we at least get a bounce. But to me, I don't think you bottom here. Next, chart 27, here's the NASDAQ weekly. Okay, remember this divergence has been for a while. Here you can see the uptrend channel. We've been in this channel since late 2022. Also, we're working. It's possible we could have put in a 5, or we're still working on that, but you can see 5 ways up here on the smaller time frame. 1, 2, 3, 4, 5. Next, chart 28, here's the KISS high performance system. Anyway, you can see the big sell-off on Friday. Smart trailing stop here is 518.47. By the way, I also will be adding a new version of this coming soon as well. Again, the stats are improving with this new code change I made for all the high performance stuff. But anyway, this smart trailing stop is still a little bit ways below. Next, chart 29, here's the daily chart. Here you can draw a pretty obvious rising wedge, and you can count 5 waves. Right? Big sell-off on Friday. Again, we're still holding this uptrend line, still above the 50-day, but bulls need to hold this area if they want to get another shot higher. Otherwise, we could have completed wave 5. You have a MACD divergence up there. Chart 30, here's a 60-minute view. Again, you can count 3 waves down. So it could be A, B, C, or 1, 2, 3. Again, 1, 2, 3 could be bearish. It could also still be 1, 2, 3 of a wave A. So, that's the thing about Elliott wave. There's always, options. But regardless, there's no divergences or anything down here. So that's why I don't think this is done. And chart 31, here's a 15-minute view. We are into kind of a little demand zone down here. Again, no divergence on the MACD or anything. Moving average ribbon is very wide, but so we could see a bounce here, but I think it's just a bounce. And finally, chart 23, here's IWM small caps. They got absolutely pummeled on Friday, down the biggest for the indexes for the week, down almost 3% on Friday alone, closing right back at its 200-day moving average. Man, this sector is really underperformed. And finally, chart 33, here's the 2-hour view. So we had an obvious coil late last week. Well, it broke to the downside hard. All right, guys, that does it for the indexes. So again, we'll see how futures open here in a little while. Moving on, let's look at some indicators. So chart 34, here's the VIX. So the VIX, nice move up on Friday, but still didn't close above its upper Bollinger Bands. And look at my comments on February 12th. So a couple weeks ago, pinching, Bollinger Bands are pinching, energy building. So that's been my worry about the market. You know, when the Bollinger Bands pinch like this, often results in a big pop higher, just like you see back here last year in July, June and July, it was really pinched and then boom, popped higher. You had a pinch in December, then it popped, and you have a pinch now. So this could still lead for more upside in the VIX, which would lead for more sell-off in the market. Chart 35, here's the 60-minute chart showing these gaps. Again, it was kind of basing here at this demand zone, and of course, big pop on Friday. Next, chart 36. Here's another chart that was showing a warning. This is the S&P to XOP ratio. So XOP tends to be a defensive area. And so when I do the ratio here, it moves with the market. Okay. When you see these divergences, like you had one last August, that played out. And then you had another divergence here recently. You could see the S&P XOP ratio was smashing down, making lower highs, while the S&P was making higher highs. So this is a divergence. And you can see this closed below its Bollinger Bands on Friday. Again, we are short-term oversold. Here's the McClellan oscillators for the NASDAQ. That's the NAMO, closed below its lower Bollinger Bands. And the NIMO, that's the McClellan oscillator for the NYSE, also closed below its lower Bollinger Bands. Again, usually, many times you get a bounce off that, but sometimes you need 2 or 3 days below the Bollinger Bands before you get your bounce. You can see the past examples. So again, short-term oversold. Now in the S&P 500, the McClellan oscillator is still well below its, way far from its lower Bollinger Bands. So, you know, if the market really wanted to dump here for a little bit, you know, that's going to take the market would have to dump quite a bit for this to get below its lower Bollinger Band. So just be aware of that. You can see the last examples were all good buy signals in the past. Okay. Sometimes they're a bit early, but generally decent. But so we're not even close for that on here. So just pointing that out. Some other things, chart 39, here's the breadth thrust indicator. So just pointing this out, usually whenever this gets oversold, you get your decent lows in the market. Well, this isn't anywhere near oversold yet. Chart 40, here's S&P versus high yield corporate. Now, one positive for the market would be high yield corporate did pull back on Friday, but it barely pulled back. It's holding up much better than the market, and the market tends to follow this. So just be aware of that. And here's high yield corporate itself. Like I said, it did pull back on Friday. It is wedging here, which had been shown, but it is holding up better. So that's one slight positive for the market. Chart 42, here's the 10-year Treasury yield. Big smash last week again and on Friday. Didn't help the market though. Or small caps. Now, let's look at some of the, before we get into that, TLT 20-year bonds rallying up. And this still, TLT looks like it wants higher. So this goes higher, we should see rates continue to pull back. Now, let's look at market sectors. We're going to look at a bunch of these just to show you how things look like under the surface. So here's XOK technology. Last week I showed this little sloping trend line as resistance. Well, that ended up being the case. Smashed down hard on Friday, right to these moving averages. Chart 45, here's semiconductors, obviously smashed. Nice rally off that demand zone though. Closing right at these bunched up moving averages. So remember, NVIDIA reports on Wednesday after the close. That's obviously a big name. So we'll see how it does. Chart 46, financials. Remember, the financials and banks have been very strong, making new highs after rallying off that demand zone in January. But little double top here recently, pulling back. Still strong, but maybe 50-day moving average could be next target. Chart 47, FAZ, that's the triple inverse ETF for financials. So on Friday morning, I posted this to our subscribers. I said it looked like a bull flag. It gave a nice pop. So that was a nice trade if you're a subscriber and you saw my post. If you're on YouTube, you wouldn't have saw that. Chart 48, banks. Nice sell-off here, a little bit weaker than financials, closing right near the 50-day moving average. Here you can count little 5 waves up recently. Chart 49, transports, coiling action, big sell-off though, so otherwise kind of a coil pattern setting up here. Chart 50, industrials, so far a 3-wave ABC-like pullback. Here I added some fibs right around the 61.8 fib. Chart 51, IYR real estate. So this has an ominous little bear wedge here, so it could be a little short candidate to watch. Chart 52, home builders. Been absolutely smashed. Last bounce, lower high around that 50% fib, and boom, taking out recent lows here. Looks weak. And here's the bigger picture view of home builders. Kind of has a head and shoulder look to it here, so be aware of that. Chart 54, healthcare. Also been pulling back here recently from that last supply zone. Still above its 50-day moving average, but right around its 200-day. Chart 55, biotech, pulling back off that supply zone. It's been very choppy. Chart 56, utilities have been inching higher, more of a defensive sector. Still very strong. Chart 57, XLP, consumer staples. Remember, more of a defensive sector. Perfect support off that demand zone. It's been rallying up. Now that is into a little supply zone up in here, but otherwise it is quite strong. This could easily go back to a high. That wouldn't be good for the market. Next, chart 58, here is materials. Big smash down on Friday. So you can see overall lower high. And the energy market, here's XLE. So remember, we got a nice rally off that 61 fib, but pulling back on Friday, obviously. Still pretty strong here, but we've got a lower high in place. A lot of V moves in this thing from November. Straight move down, straight move up. Just a lot of V action lately. I do like this sector longer term. And some of the world markets have been on fire. Here's yen. That's the China 3X ETF. You had a perfect 5-wave ABC pullback into January. Hell of a move here. Thing basically doubled. It is a bit extended here, black candle doji, but this has been a hell of a runner. By the way, the KISS high performance system has done very well in this trade. Chart 61, Baba, Alibaba, Chinese name, pointed out this falling wedge back in January. I wish I had bought it, loaded up. Thing is just went absolutely gangbusters. Look at this, no MACD divergence, no RSI divergence. Very overbought, but my God. And another area, guys, EEM to SPY ratio. So emerging markets, as you can see on this ratio, have been underperforming since 2010-11. But this is one of the macro changes I'm talking about that I'm watching. Eventually, so it's been best, basically, simply put, it's been best to be overweight the S&P over emerging markets if, emerging markets are part of your diversified portfolio. But eventually, trends change. Eventually, we're going to see emerging markets outperform. And I'm watching this special K indicator here. You can see this, when it crosses this red line, it's been pretty damn good. Chart 63, here's emerging markets on the daily. It's had a nice rally off that January low. Little pullback on Friday, but not much considering what the U.S. markets did. I'm going to be adding EEM to the high performance KISS systems, by the way. All right, moving on to commodities. Chart 64, DBC, weekly view, up 1%. Here it's been in this horizontal range for the last 2 years. Again, I'm expecting this to eventually break out and commodities to lead. Here's the holdings if you want to break it, see what the breakdowns are. Chart 65, here's the monthly view, so up 3.1% for the month. Notice how the MACD is recycled and is trying to curl up. Energy's building on this puppy, folks. Next, chart 66, here's the daily. Well, you had a couple dojis up here. You could see it circled. So we got smashed on Friday. Not surprising, guys. On a day like Friday, a lot of things get sold off. But we were up. But longer term, I like this area. Chart 66, here's the CRB to SPY ratio. So just like in emerging markets, commodities have generally underperformed. But to me, we completed a wedge, and I think commodities could outperform this year. Here's the daily view of the ratio, DBC SPY. You got a perfect 5-wave wedge down. And I've been postulating for this to curl back up, which it's trying to do. Next, number 69, here's crude oil down 0.4% for the week. Still in the same range it's been stuck in for the last year and a half, kind of a wedge pattern. Chart 70, here's the daily view of crude oil. So it's been bouncing around this demand zone here. It's amazing how well energy stocks are holding up considering how weak crude oil is. Logical pullback from that supply zone, of course. Chart 71, natural gas has had a hell of a rally. Last week up over 12%. It is quite extended here short term, so be careful. Really awesome trade though if you went long back here on this 50-day moving average test, or whenever it finally broke and held that 200-day moving average. Chart 72, copper down last week 2.25%. Chart 73, here's DBA finally pulling back. Agriculture, it's had a hell of a run, so finally a reprieve on this. Chart 74, here's wheat. Wheat that came out of this rounded bottom still looks actually pretty decent for me. Flagging. And chart 75, coffee, finally pulling back. Last week we had a spinning top doji, very extended. It's had a hell of a rally off that double bottom from 2023. So little mean reversion action. And moving on, chart 76, Bitcoin. So Bitcoin's been just kind of chopping around here. It has not been moving with the market. Now, on Friday, it didn't really move down much either, though. So, it's been just stuck around this range. I mean, the bearish view is this is kind of a complex head and shoulder, rounded umbrella top. We'll see. This is a big support. This needs to hold. If not, there's a big air pocket in here. These big up candles represent really no support. Chart 77, here's IBIT, Bitcoin ETF. You can see the smash down from the 50-day moving average, 20-day. You can see this. The bearish view would be this is an umbrella top sort of thing. Chart 78, US dollar. So far, logical pullback from that supply zone from the last couple months. Chart 79, here's the daily view. Broke that pattern. Bouncing here a little bit here, but otherwise, moving on. Chart 80, here's Japanese yen, weekly view. Nice rally off that double bottom supply demand zone, And the bigger picture view, here's the monthly. Remember, FXY is the ETF for the yen. You had a wedge pattern here, MACD divergence. Remember, this is the monthly chart. Back test of the wedge and rally. To me, the yen looks low risk long for a swing. Moving to precious metals, chart 82, gold up 1.8% for the week. And we still have a potential MACD divergence here, RSI divergence. We've been working on a wave 5, but no sell signals. Still haven't tagged that 3,000 round number yet, but I do believe that is a target over time. Next, number 83, gold on the daily. Still stuck in this little range here. Can we get a little quick pop to 3,000 here in the short term? We'll see. Nice rally off that ABCDE coil. There's the tradable ETF, GLD, demand zone down here. Chart 85, silver. So silver's been chopping around here. It's moved up after breaking out of that coil, but hasn't been pushing here. Eventually, I think we're going to see silver pop hard, but it's more just a slow boil higher at the moment. Here's a 60-minute view of the ETF's SLV. You can see kind of a coil that could be forming here. And chart 87, here's the monthly view. Again, broke out of this big monthly coil with March of last year. It's been stuck in this supply zone. Over time, I'm looking for it to go to that next supply zone. So I think it's a good swing long term, but it's just been choppy lately. Next, chart 88, GDX, the miners. Last week, it ended with a black candle, doji. So a little logical sell-off here last week. Chart 89, here's the daily. So again, there was a supply zone up here, pulled back. Remember, it held that last demand zone, ABC pullback. Now, the bullish view is here. To me, this looks like one strong move up, like a wave 3. So to me, this could maybe form a cup and handle. I don't think this move is done. I could see a little 3 waves down. You got the 20-day moving average, so that could be a little area to watch. Here's a 2-hour view of GDX. Broke that channel last week. The bullish view is we got a little ABC pullback going. Here I marked some gaps and added some fibs to monitor. One of the long ideas I put on in the mining stocks was the AEM a couple months ago out of this coil. Played out beautifully. Here's the daily chart. You can see the coil. It does have a potential flag here, so still one to watch. And like I said, guys, because of the volatility, I haven't put out any new ideas here, trade ideas. So Intel, just discuss a couple things. Here's Intel. I did point out this demand zone that went back to 2012 and 13. I said it looked like a low risk buy there. And so far this month, up 28%. Off the highs, it was up a lot more than that, but it was at least worth a trade there. Intel, as you know, so many fundamental reasons. It's been smashed the last several years, but it was worth a shot there. Here's the daily. Again, beautiful support. Look at how many times it tested this support. 5 times going back to August. Pulling back here, but the pullback is on lighter volume. It appears to be flagging, so I'd be looking to buy this pullback. Driver 94, SELH, a little long idea from last week that popped on earnings. If you bought it inside this pattern, congrats. To me, it looks like a breakaway gap, so I think this could still follow through much higher. And Driver 96, STM, another one that last week my ideas had a breakaway gap out of here. I said those are bullish. And again, it may need to retrace a little bit, but ultimately these are breakaway gaps. All right, guys, we'll see how futures open here in the next hour or so. And so far, indications are that futures will be flat. But again, I expect some fireworks. So, I don't expect things to be tame. All right, guys. Again, I appreciate your support. Looking forward to a great 2025. Appreciate all you guys on YouTube. And on YouTube, if you can please like and subscribe. Like and comment. Comment if you can. That really helps the channel out. Not enough of you comment, so please do so. Even if it's just gibberish, I don't care. Just post some comments. All right, guys. We'll see what happens this week. Take care.